If you've been watching this series or if you've done any research on reverse mortgages at all, you've probably found a lot of content explaining how they work, what the requirements are, and what happens to your spouse and how repayment works. What you don't find as often is someone stopping to ask the more fundamental question, should you even get one in the first place? That's what this video is about. A reverse mortgage is a real financial tool with real benefits for the right person in the right situation, and it can be a costly mistake for someone who hasn't thought through whether it actually fits their life. So before you talk to a lender, before you run the numbers, I want to walk you through the questions that actually determine whether this makes sense for you. And I pulled this directly from HUD's own guidance on the subject. One of the most important things HUD's guidance says about reverse mortgages is also the most straightforward. Look at all of your borrowing and housing options before making a final decision. Not some of them, all of them. That framing tells you something about how HUD views this product. A reverse mortgage isn't a universal solution for homeowners over 62 who need access to cash. It's one option among several, and whether it's the right one depends entirely on your specific situation, your timeline, your household, and your financial picture. Two people can look identical on paper, same age, same home value, same equity, and one of them might be a great candidate for a reverse mortgage, while the other would be better served by a completely different approach. That's why this decision requires honest answers to real questions, not just a lender telling you what you qualify for. The single most important factor in whether a reverse mortgage makes sense for you is how long you intend to stay in the home, and HUD's guidance is explicit about this. A reverse mortgage usually makes more sense the longer you live in your home. So if you're planning to stay in that house for the rest of your life or for a significant number of years, the structure of a reverse mortgage can work well for you. You have the time to use the equity you've built, the loan balance grows over a long period, and the costs are spread across a longer timeline. If a health issue or a desire to downsize or a move to be closer to family or any other circumstance might cause you to leave that home in the near future, a reverse mortgage is an expensive way to cover a short-term cash need. The costs involved in originating the loan include upfront mortgage insurance premiums, origination fees, and closing costs are significant, and they make the most sense when they're amortized over a long stay, not a short one. Someone who takes out a reverse mortgage at 62, intending to move at 68, is paying a lot of money for 6 years of access to their equity, when other options might accomplish the same thing far more efficiently. A reverse mortgage eliminates your monthly mortgage payment, but does not eliminate your financial obligation on the home. To keep the loan in good standing, you must continue paying all property charges, which include property taxes and homeowners insurance, flood insurance if applicable, HOA fees, condo fees, or ground rent, and any other special assessments. You must also keep the home in good condition, which means ongoing maintenance costs don't go away either, and we'll come back to that here in a moment. The core question to answer honestly before moving forward is whether you can afford to keep paying these charges for as long as you plan to stay in the home. Not just right now, but years from now. If the answer is uncertain, the CFPB's guidance is direct. If you run out of money to pay property taxes, insurance, or other housing-related expenses in the future, you could face foreclosure. A reverse mortgage can help cover living expenses and free up cash, but HUD's guidance also notes that it's important to have other retirement resources too. The reverse mortgage shouldn't be the only financial tool you're relying on. So if you're considering a reverse mortgage specifically because you're already struggling to cover property charges, that's a sign to have a much deeper conversation about the full financial picture before moving forward. What happens if you fall behind on those charges is worth understanding before you're in that situation. If your loan goes into default due to unpaid property charges, the first step is to contact your lender or servicer immediately and reach out to a HUD-approved housing counseling agency or an attorney who can explain what options remain. After a default, it may be possible to rehabilitate the loan through a repayment plan, but that requires action, not waiting. There's also a provision called an at-risk extension, which applies specifically to borrowers who are at least 80 years old and experiencing critical circumstances such as long-term disability, a terminal illness, or a documented unique need to remain in the property. An at-risk extension can be renewed each year with proof of that need, but it requires meeting the age and circumstance threshold and is not available to everyone in default. So if you receive a formal default or foreclosure notice, the worst thing you can do is ignore it because the options available to you narrow the longer you wait to respond. Most people evaluating a reverse mortgage think carefully about the financing obligations like taxes, insurance, and monthly cash flow, but the home condition requirement is the one that gets far less attention, and it can be just as consequential. You're evaluated whether the home meets HUD's property requirements. Now that you have the loan, you are required to keep the home in good condition for as long as the loan is active. Your lender or servicer may inspect the home's condition after giving you notice and specifying the purpose of the inspection, and they may require you to make repairs. If repairs are required, you generally have 60 days from the date your lender or servicer notifies you to begin making them, and failure to do so can lead to default or foreclosure. That timeline matters because home repairs, especially for older homeowners on fixed incomes, can be difficult to arrange and fund quickly. If you cannot afford to make required repairs, your local area agency on aging can connect you with assistance programs that may be able to help cover the cost. You can find your nearest agency on aging by calling 1-800-677-1116 or visiting eldercare.acl.gov. A home that needs ongoing or significant maintenance, or a borrower who won't have the resources to address repair requirements if they come up, can turn a loan that looked manageable into one that creates serious problems down the road. If your home requires significant upkeep and your budget is tight, that's a factor worth weighing honestly before signing anything. There is a reason HUD's guidance specifically asks whether you can wait until you are older, and it comes down to how the loan is structured. The older a borrower is, the more money they can borrow through a reverse mortgage. That's built directly into how the principal limit is calculated, which uses the age of the youngest borrower or eligible non-borrowing spouse as one of the key inputs. A borrower who takes out a reverse mortgage at 62 will have access to significantly less of their equity than the same borrower would at 72, assuming all else is equal. So for borrowers who are in their 60s and thinking about this, waiting even several years can meaningfully change how much you can access and how much flexibility you have and how you use those funds. The guidance is consistent on this point. Borrowing too soon can leave you without resources later in life when you may need them far more. That doesn't mean waiting is always the right answer. Every situation is different, but it does mean that timing deserves real thought, not just a check of the eligibility box. A reverse mortgage isn't just a decision about your finances. It's a decision that affects everyone in your household and potentially your family after you're gone. Starting with your spouse or partner, HUD's guidance is clear that if you live with a spouse or partner, it generally makes sense to apply as co-borrowers so that the co-borrower can continue to live in the home and receive loan benefits after you move out or pass away. A spouse who is not on the loan faces a much more complicated situation, and the protections available to them depend heavily on when the loan was originated and whether they meet specific eligibility conditions as a non-borrowing spouse. That conversation needs to happen before the loan closes, not after. Beyond your spouse, if there are other family members living in the home who are not co-borrowers or eligible spouses, they will be required to move out or repay the loan when you move or pass away. I recommend preparing any non-borrowing family members living in the home by deciding together what will happen after you pass away. If your children or other heirs have an expectation of inheriting the home, a reverse mortgage directly affects that. They will need to either repay the full loan balance or 95% of the appraised value, whichever is less, if they want to keep the property. None of these outcomes are necessarily deal breakers, but they all require honest conversations with the people that they affect before a decision is made. HUD doesn't just suggest looking at alternatives to a reverse mortgage, it requires it. Before a HECM loan can close, every borrower must meet with a HUD-approved housing counselor who specializes in reverse mortgages, and that counselor's job is specifically to make sure that you've considered all your options, not just the reverse mortgage. The alternatives worth understanding include a home equity loan or home equity line of credit, which might accomplish the same goal at a lower cost, though both typically require monthly payments and depend on your income and credit. So refinancing your current mortgage with the new traditional mortgage, which could reduce your monthly payment obligations without tapping into your equity at all, is another option. And state and local programs that may be able to help you defer property taxes or provide assistance with utilities and home repairs are also an option usually. And then selling the home and moving to a more affordable property, which for some people is actually the most financially sound path. So none of these alternatives are depending on your income, credit, and market conditions, but the exercise of actually evaluating them before deciding on a reverse mortgage is one HUD considers non-negotiable for a reason. So if you've already looked at all of those options and a reverse mortgage is still making the most sense, that conclusion is much more solid than one reached without ever asking the question in the first place. Because this decision is complex enough that HUD requires independent counseling before any HECM can close, it's worth understanding what that counseling session is designed to do and what you should bring to it. A HUD-approved housing counselor who specializes in reverse mortgages will go through your full financial situation with you and help you understand how the product works, what your obligations will be, and what alternatives exist for your specific circumstances. To get the most out of that session, come prepared to discuss your financial needs and goals, your spouse or partner's future housing and financing needs, the circumstances that led you to consider a reverse mortgage, and the alternatives you've already looked at. So if you have quotes from lenders by that point, the counselor can help you compare them directly. This counseling is not a formality. It's one of those substantive customer protections and specific about your situation as you can be. Pulling everything together, the decision comes down to honest answers to a specific set of questions that HUD's guidance frames directly. Do you plan to stay in this home long term? And is that plan realistic given your health, your family situation, and your preferences? Can you afford to keep paying property taxes, insurance, and maintenance costs for as long as you intend to stay, not just right now, but into the future? Is your home in a condition you can maintain, and do you have the resources to address any repairs as they're required? Is there a spouse or partner in the household, and do they understand what happens to them whether they're on the loan or not? Are there other people living in the home who need to know what will happen when you're no longer there? Have you genuinely looked at alternatives, including home equity loans, refinancing, state assistance programs, and downsizing? Could you wait a few years and be in a meaningfully better position to use this tool? A reverse mortgage is the right answer for some people. It genuinely is. But the only way to know if you're one of them is to work through those questions carefully and honestly, ideally with a HUD-approved counselor who can look at your specific situation with you. Closing CTA. If you've been thinking about a reverse mortgage and want to work through whether it actually fits your situation before talking to a lender, use the link below to book a call with my team and we'll walk through it together. If you want clear, reliable explanations of mortgage programs and how they apply to real decisions, make sure to hit that subscribe button as well. My goal is to give you accurate information so you can make informed decisions with confidence and ultimately win with Wade. We'll see you next time.